Hi everyone, hope you all must be doing great. So let's start with a very quick revision for the chapter of capital gains. We are doing it from the chart book and you can easily download the chart book from the website. I'll also share the link. This would be a very quick revision. In case you are looking for a detailed revision for capital gain, the detailed revision video was already uploaded. If you would like to watch it, I'll share that link also so that you can watch the detailed revision also. This would be comparatively a very quick revision. So if I'll start with the section of capital gain, the chapter of capital gain, we understand that there are section which starts from section 45 till 55 are the sections which are covered under this particular head capital gain. Section 45(1) is a charging section and it says two important things. There must be a capital asset. Now you know what is a capital asset. It is defined under section 214. So if there is a capital asset and the capital asset is getting transferred, by transfer we mean if it is getting sold, if it has been exchanged, if there is a right which is getting extinguished or the right is getting relinquished, and even the conversion of capital asset into stock in trade, these all things are comes under transfer. Compulsory acquisition of a capital asset, that also comes under transfer. So if there is a, please remember that if there is a transfer of a capital asset, then this charging section 45(1) says that it will be taxable in that very year where the asset was transferred. Whether you have received the money or not, general provision says that in the year whenever you have transferred this particular asset, we are going to tax you under the head capital gain. But yes, there are certain exceptions also to this point. There are certain exceptions we will see in the provisions where there is a capital asset and we convert that capital asset into stock in trade, right? So in that case we defer the capital gain taxability. We charge capital gain in that year where the stock is actually sold. So there are certain exceptions to this rule. Even if there is a capital asset which is destroyed and insurance company gives us a claim, the insurance claim, so in that case also there is an exception. It will be taxable in the year when the insurance claim is actually received. And also one more exception, if the capital asset is compulsory acquired. So in the year when it is compulsory acquired, although it is transferred, but it will be taxable in the year when the compensation from the government or from the person who has compulsory acquired in the year in which it is actually received. So that I'll be discussing. But the general provision says that it will be taxable in the year in which the capital asset is transferred. This is the general provisions. Yes, we do have some special provisions also. So this is the charging section. Now, very important concept of capital asset. So we know that capital asset is defined under section 214. It says that generally all assets are capital assets. All assets are capital assets, whether they are your personal assets also, they are capital assets, business assets also as capital assets, movable, immovable, tangible, intangible also. So if someone is selling their goodwill, someone is selling their brand name, someone is selling their trade name, then also capital gain will arise because all assets are capital assets. But again, there is an exception. There are certain assets which will not be considered as capital assets. So if they will not be considered as capital assets, there would be no capital gain in that case. So we understand stock in trade will not be treated as a capital asset. So if someone is holding an asset as a stock in trade, so that will not be a capital asset because we understand that if this person is transferring their stock, then PGBP income will arise, right? So stock in trade, so it depends whether that asset is a capital asset for that SSE or it is a stock in trade for that SSE. So if it is stock in trade, please don't calculate capital gain. In that case, we have to compute PGBP income. Second is personal movable assets. See, here we have mentioned that all assets are capital assets. But here now it says that personal movable assets. So if you have any personal asset plus movable also. So if you have personal immovable, like you have your personal house, personal land, personal building, that is a capital asset. But if it is a personal movable assets, like my laptop, my camera, these are all personal movable assets. Although I use my camera, I should not use my camera in that case because I'm using it my profession. So let's say if it is, let's say my home furniture, that is a personal movable asset. My personal car is a personal movable asset. So on personal movable assets, we don't calculate capital gain. Rural agriculture land, you understand, it will not be considered as a capital asset. But if it is an urban agriculture land, so if the person is selling their urban agriculture land, then capital gain will arise. And we also know one more provision of section 1037, also not important to learn the section number, but we understand that if, because rural agriculture land is anyways is not capital asset, so there would be no taxability in that case. But if the person is transferring their urban agriculture land, let's say person is selling their urban agriculture land, then capital gain will arise. Yes, I was telling you, if the urban agriculture land is compulsory acquired, I'm again repeating, if the urban agriculture land is compulsory acquired, then we have a provision in section 10, it will be exempt, right? So urban agriculture land is a capital asset. If you are voluntarily selling it, then capital gain will arise. But if you are transferring it because of due to compulsory acquisition, then capital gain is exempt in that case. And gold deposit bond also are not considered as capital asset. So if someone is transferring their gold deposit bond, then capital gain will not arise. It is different from sovereign gold bonds. Sovereign gold bonds are completely different. So in sovereign gold bonds, if you sell, then capital gain will arise. But yes, in sovereign gold bonds, there is at one point is covered under section 47. So if sovereign gold bonds are redeemed and they are redeemed in the hands of individual, so in the hands of individual there will be no capital gain, that we will see in section 47. Okay, so we have understood that personal movable assets are not capital assets, but we have certain exceptions also. Certain exceptions are, if you have your personal jewelry, precious, semi-precious stones, diamonds, rubies, etc., these will be considered as capital assets. Paintings, drawings, sketches, sculptures, you understand, any piece of art, any archaeological collection, even your securities, if you have shares, if you have debentures, these are also considered as capital assets. And virtual digital assets like bitcoins, they will be considered as capital assets. So if someone will transfer these assets, then capital gain will arise. So see, these are, some of these assets are personal movable, but it is an exception to that part, right? So if you are selling these precious, semi-precious stones, paintings, drawings, sculptures, then it will be regarded as a capital asset, and on transfer, capital gain will arise. One more important thing, please remember, especially for MCQ. See, it is for FIIs, foreign institutional investors. So foreign institutional investor generally buys and sells securities. So generally they are into such business. But for them, if they are transferring their securities, then these securities are treated as a capital asset. So whenever these financial institution, this foreign institutional investors, FIIs, will sell their securities, it will be considered as a capital gain, because it is, securities are here covered under capital assets. So please note, securities held by FIIs are also capital asset. So for them, there would be no PGBP income. For them, it would be capital gain only. Okay. Now, how we determine that whether the capital asset, whether the capital gain which we are getting is a long-term capital gain or a short-term capital gain? So it depends upon that asset period of holding. So for how long we have holded this particular asset. So generally, if it is transferred after 3 years, then we call it long-term. But if it is transferred before 3 years or even up to exactly 3 years, then we will call it short-term, right? So 3 years is a general, we have to see the term, the period. If after 3 years, long term, up to 3 years, short term. But there are certain exceptions, and this is something which is very important. There are certain exceptions. For some of the assets, we don't take 3 years, we take 1 year, and for some, we take 2 years also. So this is important. 1 year is taken for listed securities. I have mentioned the word listed securities. Securities here could be shares also, debentures also, other bonds also, other securities also. So if they are listed and we are transferring it after 1 year, it would be long term, right? Listed debentures, listed shares, any share, preference, equity, any, right? Equity oriented units of a mutual fund. What are equity oriented units? Those mutual fund schemes where they invest 65% or more of their corpus towards equity shares. That is called equity oriented mutual funds units. So if we are selling these equity oriented units of mutual fund after 1 year, it would be a long term capital gain. or long-term capital loss, as the case may be, but it will be long-term. Units of UTI, Unit Trust of India, and zero coupon bonds. So please remember these four things, that if we are transferring these things after 1 year, they will be considered as long-term. If we are transferring it before 1 year or even exactly up to 1 year, short-term. 2 years for unlisted shares, equity or preference, both. See, I have mentioned listed securities, but here I have mentioned only unlisted shares. So if the assessee is transferring their unlisted shares after 2 years, it would be long term, right? If it is before 2 years, it would be short term, correct? So in case we are transferring our unlisted debentures or unlisted bonds, so should we take 2 years? No. See, unlisted things will not be covered over here, and here only unlisted shares are covered. So if the person is transferring their unlisted debentures or unlisted bonds, please take it 3 years. Generally, it is 3 years, correct? Land, and this is important. So if the assessee, please don't make a mistake over here. If the assessee is transferring their land or building or both, then after 2 years, it will become long term. Up to 2 years, short term. After 2 years, it will become long term, right? And there is an important amendment also. Section 50AA is inserted by Finance Act 2023, and this is quite important. It says, it's a very small section, but it is important. It says about two things. If the assessee is transferring their market linked debentures or specified mutual fund units, market linked debentures, please understand, market linked debenture or specified mutual fund units, then irrespective of their holding period, whether we are selling it after 3 years, 4 years, 5 years, 10 years, it will be always be short term. It will always be short term. So for market linked debentures, specified mutual fund units, please take it always short term. This is important. Okay. See guys, this is a very quick revision, so I'm not explaining you that in detail, but yes, I'll be covering all the sections, right? Section 48 would be computation of capital gain. How we compute our capital gain. So the computation is very easy. Selling price minus cost price. We call selling price as full value of consideration, and cost has three parts: cost of acquisition, cost of improvement, and expenses on transfer. So whenever we deduct these three things, cost of acquisition, cost of improvement, and expenses on transfer, you can deduct expenses on transfer also first, that is okay. So once we deduct expense on transfer first from full value of consideration, we get net consideration. After that, you can also deduct COA and COI, or you can keep it this way also. So this way you will get your capital gain. So this is a short-term capital gain. Why this is short-term? Because for long-term, the computation is a little bit different. What we have to do in long-term, for COA and COI, we have to index it. You know how to index a particular cost of acquisition or cost of improvement. So in case of long term, full value of consideration less index COA, index COI, and expenses on transfer will not be indexed, right? So how you index, also you understand, whatever is my cost of acquisition, we multiply it by CII. In the numerator, we will put CII of the year of transfer, right? Please remember, in the numerator, we will put the CII of the year of transfer. So CII of the year of transfer will be given to you in your question. And we understand generally for this year, for previous year, 23-24, the CII is 348. But it will be given, it will be mentioned in the question. So in the numerator, we have to put the CII of the previous year in which the asset is getting transferred. And in the denominator, we have to put that CII in which it was acquired by the assessee. So CI of the year in which the asset was first held by the assessee or first acquired by the assessee, please put it in denominator so that you can compute your index cost of acquisition, and the similar way you can calculate your index cost of improvement. See, please remember this point also, because there is a case of Manjula J. Shah. It says, so generally the section, as per the law, we have to take CI of the year in which the asset was first held by the assessee. So let's say if actually the assessee is Mr. D, who is a son of he's a son of Mr. X, let's say. So let's say if Mr. X has transferred this asset to their son, so can we take the CA of the year of son or CA of the year of father also? Of the father also we can take as per Manjula J. Shah. Please remember this case also. Okay. And CA of the previous year is 348. You don't have to learn this. CI starts from 1st April 2001. From 2001 and 2, we have the CI of 100. So if any asset is acquired before 1/4/2001. So if in case we are doing indexing of that particular cost of acquisition or cost of improvement, we have to take in the numerator as 100 because we don't have CI before 1/4/2001, right? And also we have a facility. What we can do is we can also take our deemed cost of acquisition. What is deemed cost of acquisition over here? So whatever is the actual cost, please compare it with the cost as on 1/4/2001. So whichever is higher would be the beneficial for the assessee. So he should take whichever is higher. So actual cost or fair market value as on 1/4/2001, whichever is higher would be beneficial to the assessee. That assessee should take that as a deemed cost, and for that cost we have to index it, right? And specifically for land and building, please remember specifically for land and building. For land and building, if SDV is also given to SDV is what? Stamp duty value. If stamp duty value as on 1/4/2001 is also given to you, so you have to compare fair market value with SDV. So first we have to compare fair market value and stamp duty value. If stamp duty value is not given of 1/4/2001, it's okay. You can ignore it. But if it is given, so first of all, compare FMV and SDV. Whichever is lower, you have to take. Whichever is lower, you have to take. And this lower compare with the actual cost, whichever is higher. Correct? So in case of land and building, fair market values on 1/4/2001 should not exceed the stamp duty value. So in other words, we can say fair market value as on 1/4/2001 or SDV as on 1/4/2001. First take that value, whichever is lower, take that value as on 1/4/2001 and compare it with the actual cost, whichever is higher there. Okay. And any improvement before 1/4/2001 is to be ignored. So this is again important. If the assessee or even the previous owner has incurred any expenses related to improvement before 1st April 2001, always ignore that improvement cost, right? And for long term, we understand that we have to apply indexation also. But there are certain exceptions to it. There are certain things on which indexation is not allowed. So if you are selling, your assessee selling their bonds or debentures, then there would be no indexation on bonds and debentures. And again, there is one more further exception. If the assessee is selling capital index bond or sovereign gold bonds, if the assessee is selling capital index bond or sovereign SGB, sovereign gold bonds, so here indexation is allowed. Here indexation is allowed, but generally for bonds and debentures, if it is long term, see if it is listed debentures or bonds, so after 1 year it will be long term. If it is unlisted debentures, then after 3 years it will be long term. I'm so sorry. Got it? But please do not do indexation for these bonds and debentures. But yes, if it is CIBs, capital index bond, or SGBs are sovereign gold bonds, then indexation is allowed. Right. And one more thing which is added by Finance Act, although this is very not that important, but still, if it can come in your, because this is an amendment, again, examiner can ask you this point also. So do not include any interest expense in cost of acquisition or cost of improvement if you have claimed that interest expense as a deduction. If you have already claimed that interest expense as a deduction, please never add that interest in cost of acquisition or cost of improvement. So deduction under, if you have claimed any interest deduction under section 24B, 24B is house property section, where you have borrowed the money and you are paying interest, then you would claim deduction under section 24B. So if the assessee has already claimed a deduction under section 24B, so we have already given him an advantage, right? So we'll not give a dual advantage to them. So they cannot add that interest in their cost again, right? Or cost of improvement as the case may be. So if the assessee has claimed any interest deduction under section 24B or under any of the section of chapter 6A, then if the assessee has already claimed a exemption or claimed a deduction, then we understand that we have already given the assessee an advantage. So that interest portion can never be added in cost of acquisition or cost of improvement. So this was a small amendment done by Finance Act 2023. Okay. An important section 45(1)(a). 45(1)(a) says that if any asset is destroyed, and the assessee is receiving insurance claim. So first of all, if the asset is destroyed and the insurance claim would be received by the insurance company, then it is regarded as transfer, right? It will be regarded as transfer, provided that insurance claim would be received, right? So it will be regarded as transferred in the year when the asset was destroyed. Generally, we understand that whenever transfer happens, we'll charge the capital gain tax also. But here, there's a special case. Here, whenever we will receive the insurance claim from the insurance company, let's say the asset was destroyed in previous year, 22-23. Asset was destroyed in this year. So this is the year of transfer. But in this case, if the insurance claim is received, let's say next year, previous year 23-24, so we will charge capital gain tax in this year. So taxability will arise in this year. General provision says whenever asset is transferred, please charge capital gain tax. But this is a special provision. Capital gain will be taxable in the year when the claim is received. And what would be the full value of consideration? Whatever is the insurance claim is received is would be the full value of consideration. So let's say if they are giving in monetary form, then it is okay. But if they are giving us in kind, if the insurance company is giving us in kind, that is very theoretical point. Generally, they give you in monetary forms. But if they are giving you in kind, then please take the market value of that particular asset which we are getting it from the insurance company. So if it is in kind, then take the fair market value. Okay, so 45(1), do you understand? So whenever the asset is destroyed, it could be any natural calamity or by any fire, theft, etc. In that case, capital gain will arise if there is an insurance claim exists. But capital gain will be taxable in the year when the insurance claim is received by the assessee. Next point is section 45(2), conversion of capital asset into stock in trade. This is also always an important section 45(2). If the assessee is converting their capital asset into their stock in trade. So let's say assessee was having some gold. So gold is a capital asset, right? But after some time, let's say he has now started a jewelry business. So what he does is he converts his physical gold, which was his personal gold, into stock in trade. So in the year when this conversion was happening, it is regarded as a year of transfer. Please understand, it will be regarded as a year of transfer. But we will not charge capital gain in this year. Whenever this asset will be sold, now the stock would be sold. Whenever the stock will be sold, in that year, there would be capital gain that would be taxable. Also, there would be PGBP income also. But yes, here the point is that whenever the conversion of capital asset into stock in trade happen, it will be regarded as transfer, but we will defer the capital gain tax liability. We will defer that capital gain tax liability. We'll delay it. And when we will be charging it in the year when it will be actually sold. So you understand how we calculate this. Let's say this year, let's say at this point, we have acquired a capital asset. And after some time on this date, we convert this capital asset into stock in trade. This capital asset was converted into stock in trade on this date. And after some time on this date, capital transfer will happen, but capital gain tax will not be charged. So after some time, now we are selling it. Now what we are selling it, we are selling stock. So here PGBP income will also arise and capital gain will also rise. So how you will be calculating the capital gain in this year? So what would be the fair market value on the date of conversion? What would be whatever is the fair market value, it will be provided to you in the question. So whatever is the fair market value on the date of conversion, take it as a full value of consideration, and cost also. This was the actual cost, which you can subtract it. And if only this period up to the date of conversion, if this period is a long-term period, then you have to index the cost. If it is short-term, then you don't have to index and simply say it is a short-term capital gain. And how PGBP would be computing? Whatever is the selling price, deduct the fair market value. Up to this point, there would be capital gain. After that, it would be PGBP. And you know how you will be calculating this. This is an important provision, 45(2). Okay, again, an important section, and generally examiner asks you on this point. Section 45(5). 45(5) says compulsory acquisition of capital asset. So if there is a capital asset which is compulsory getting acquired, then capital gain will be arise. Capital gain will be taxable. Guys, there is no electricity today, so I'm sweating a bit. Okay. Section 45(5), compulsory acquisition of capital asset. So whenever a capital asset is compulsory acquired, that year is the year of transfer. Let's say there is an assessee, he was having a land, but this land was compulsory acquired by the government. So let's say in previous year, 21, 22, the land is getting acquired. So here the transfer is getting place, but the compensation we have received in previous year 23, 24. See, after 2 years we have received the compensation. So capital gain will be taxable in this year. Although transfer has happened in this year, but capital gain will tax the capital gain in this year whenever the compulsory acquisition amount, that is the compensation which is getting received, right? So whether here we are receiving partial compensation or full compensation, so we will be taxing it by full compensation. Full value of consideration would be the full compensation. Even if the partial amount is getting received, please make it full. Please take the full value of consideration as the full compensation which the government has promised to you. And if what would be the holding period? You have to take the holding period till here. So let's say you have acquired it somewhere over here till this particular point, till 23, 24, you will take the holding period, or till 21, 22, till 21, 22, because the asset was transferred in this year. So till this date you have to take the holding period, and if it is a long term, then you have to index the cost also. And what you will put a numerator, CI of the year of transfer. Transfer was happening in previous year 21, 22. So please, in the numerator, keep that particular CI of the previous year 21, 22. But yes, I again will remind you that capital gain will be taxable in this year, right? So this is how section 45(5) works. And second, it says that if there is an enhanced compensation, let's say assessee disputes this with the government, that he says that no, you have given me a less compensation, I would like to get more compensation. So whenever the assessee will receive enhanced compensation, then again capital gain will arise. And what will be the cost of acquisition? Nil in that case. Why nil? Because you have already taken the benefit of cost of acquisition when you have calculated the original amount, right? So here, whenever the enhanced compensation would be received, so whatever is the extra compensation would be taxable in the year when it is actually received. But please take COA and COI as nil. Expenses on transfer you can take, whatever is the litigation expenses, legal expenses, you can deduct those legal expenses, right? Also remember one more point. If the assessee receives any interim compensation is what? It's a kind of temporary compensation. Let's say there is a court case which is going on, there is a court case which is pending, and for the time being, government gives you an interim order, passes an interim order. Interim order is a provisional order, temporary order. In the meantime, government passes a temporary order that government pay him 5 lakh. So the year in which you have received 5 lakh rupees by passing the interim order by the government. So please don't make it taxable. Whenever the final order will be passed, this amount will be taxable in that year. Also remember this point, right? Next point is that if the compensation is reduced, this was the case of enhanced compensation. Let us take an opposite case. If the compensation is reduced, in that case, you have to recompute the capital gain which you have computed in the original year. So whatever was the capital gain which you have computed in the earlier year, you have to recompute that, right? In case of reduced compensation. Next point is that if the assessee receives any interest because of delayed compensation, it could be original compensation which has got delayed, or enhanced compensation which get delayed. So if the assessee receives any interest, so that interest will form part of capital gain or IFOS. That interest will be taxable under IFOS, and you know that on such interest, 50% deduction is available. So let's say the assessee is receiving 3 lakh rupees as interest on delayed compensation or interest on delayed enhanced compensation, as the case may be. Let's say 3 lakh rupees is the interest amount that will go in IFOS, but please take 50% deduction, and remaining 1.5 lakh would only be taxable under IFOS, right? So this was all about 45(5). And okay, here is one more point. If the although this I have discussed, see, urban agriculture land is a capital asset, right? So if you are selling your urban agriculture land voluntarily, then capital gain will arise. But if the urban agriculture land is compulsory acquired, in that case it will be exempt. Under section 10. So please remember this point. So if rural agriculture land is voluntarily sold or compulsory acquired, it will not make any difference. Why? Because rural agriculture land is not a capital asset. But if urban agriculture land is compulsory acquired, in that case it will be exempt. If you will say sell that urban agricultural land voluntarily, then capital gain will arise. But if it is compulsory acquisition, then it would be exempt. Okay. Section 46, distribution of assets by company on liquidation. So let's say there is a company. Let's say I'm a shareholder. I'm having shares of certain companies. Let's say I'm having 10% shares of certain company, which I have purchased it of any amount, which I have purchased it of X amount. So that this is my cost of acquisition, right? Now this company is getting liquidated. So in liquidation, what happens is, you understand that first company pay off their outside liability. Whatever is the outside liability, they first pay it off. So now after paying off their outside liability, now they talk with the shareholders. They say, now you surrender your shares and we will give you the amount. Whatever the amount which is left with the company, they give it to you. So let's say I'm a shareholder. I was having 10% shares of certain companies, and that company is getting liquidated. So what I'll do is, I'll go to that company, I'll approach that company and I'll surrender my shares and they will pay me off. Let's say they are paying me rupees 10 lakh to me. They are paying 10 lakh to me. So is 10 lakh is the full value of consideration. Capital gain will arise in the hands of shareholder, because my shares are getting surrendered, right? So they are paying me 10 lakh rupees. So full value of consideration would be 10 lakh rupees minus cost of acquisition would be the cost of my shares. And if it is a long-term affair, then we have to index the cost of acquisition also, right? But please remember, only a single point is here, which is important. So 10 lakh rupees, I'm getting it from the company. That is the full value of consideration. But please remember, you have to see whether there is any accumulated profit, at the time of liquidation. If there is any accumulated profit, then out of this 10 lakh, we have to split this. 10 lakh into two parts. So let's say there was accumulated profit to the extent of 5 lakh with the company. 5 lakh is for the entire company, right? And I was holding how much shares? 10% shares. So out of this 5 lakh accumulated profit, my share is 10%. That is 50,000 rupees. So if I am getting 10 lakh rupees from the company for my shares, what I'll do is, so I'll see what is the accumulated profit of my share related to my share. It was 10%. Let's say I was holding 10% share, so it was 50,000. So what I have to do is, I have to deduct 50,000 rupees out of it. So I'll make two parts of 10 lakh. One is 50,000 rupees, other is 9.5 lakh rupees, right? 9.5 lakh rupees would be the full value of consideration, not 10 lakh. Now I have to reduce the deemed dividend, right? This is under section 222C. You understand that whatever is the accumulated profit related to my share, I'll deduct that amount. So 9.5 lakh would be the full value of consideration, cost of acquisition. You understand? You can index if it is a long-term affair. And this 50,000, what you will do the treatment for this 50,000, this is a kind of deemed dividend. It will be covered under taxable under IFRS income. So 50,000 will become my IFRS income. 9.5 lakh minus cost of acquisition will be, or index cost of acquisition will become my capital gain, right? So this was again important, section 46. So let's say how I have calculated this 10 lakh rupees which I was getting from the company. Let's say it was in the form of cash, or if it is in the form of other assets, then I have to take the market value of that, right? Okay, so this was section 46, a very small section, section 46A. 46A is buyback of securities or buyback of shares. So if the company, if I am a shareholder of some company, and that company is saying that we are buying back our shares. So if you want, then you can sell the shares to the company. So again, capital gain will arise in whose hand? My hand, right? Capital gain will, because I am the one who is transferring shares and I'm getting amount from the company. So it should be taxable in the hands of shareholder. But there is a special point over here. If buyback is happening of shares, whether they are listed shares or they are unlisted shares, whether it is done by a publicly limited company or a closely held company also, then although it should arise in the hands of shareholder, but some people were doing tax planning over here. So what income tax did is, income tax said that this would be taxable in the hands of company itself. Now shareholder was not like to pay, would not be paying capital gain tax on it. Company will be paying tax on it. So if the buyback is happening for shares, here I am referring to these shares are of domestic company, whether they are listed or unlisted. So capital gain will be taxable in the hands of company at the rate of, it should be taxable in the hands of shareholder, but some people were actually misusing this provision. So I'm not going in that detail how they were misusing. But here, what income tax did is lawmakers made it taxable in the hands of company at a rate of 20% plus surcharge 12%, and on that amount you have to add 4% cess. So it will be taxable in the hands of company. And now, will shareholder will also be liable? The answer is no, shareholder will not be liable. It will be exempt in the hands of shareholder. But if this buyback is of specified securities, not of listed or unlisted shares, it is not of shares of domestic company. If it is for other securities, or even if the foreign company, in case of foreign company, because this provision is applicable only on domestic company. So if it is buyback of other securities, or it is buyback of shares of foreign company shares, then in that case, it will be a normal provision. It will be taxable in the hands of shareholder. It will not be taxable in the hands of company, right? It is only for domestic companies. So you can write it over here. It is only for domestic companies. Okay. So this was section 46A. What was section 46? Section 46 was distribution of capital assets, distribution of assets by company on liquidation. Section 47. Section 47 is again an important section. It says it contains a list of certain transactions. Although these transactions look like that the transfer is happening, but in this case, if there is a transfer which is happening as per section 47, then we will not regard it as a transfer. We will not regard this transaction as a transfer, and hence there would be no capital gain, right? So these are the transactions which are not regarded as transfer. So no capital gain in these transactions. So you should know what are the points, what are the scenarios, what are the situations where a transaction is happening. Although there is a kind of transfer, but we will not regard this as a transfer, and therefore no capital gain will be charged in this case. So whenever there is a partition of HUF, whether it is a full partition or a partial partition, so whenever there is a partition of HUF and they distribute their capital assets to to their members, then there would be no capital gain. And for members, there would be no IFRS income also, as per section 56. In IFRS, we do is that whenever we receive gift from relatives or from HUF, then there would be no tax implication also. And whenever this member would be selling their asset, whenever this member would be selling these assets which they have received on the partial or full partition of HUF, then they have to take the cost of the previous owner. And who is the previous owner? HUF. And they also have to compute the holding period, including the previous owner holding period, that is HUF holding period will also be included. I believe that you are able to recall this point also. So if there is a partial or total partial partition or a full partition of HUF, no transfer will we will not regard this as a transfer, and there would be no capital gain. Second point is that if there is a transfer of capital asset by way of gift, if you will gift your capital asset to someone, or you are giving it under a will, or by way of irrevocable trust, that is a kind of gift. You are irrevocable means permanently you are giving it to someone. So in that case, there would be no transfer. It will not be regarded as transfer. No capital gain will arise in this case also. If there is a transfer by a holding company to 100% subsidiary, and the receiver is an Indian company, the receiver, there are two conditions. That subsidiary must be 100% subsidiary. That means although we become holding company by acquiring more than half of the share capital, but here we require 100% shares. So if you are a holding company, what type of holding company? 100% holding company. 100% holding company means that you hold entire share capital of that company. Second, the receiver company should be an Indian company. So if holding company is transferring their share to 100% subsidiary company, and the subsidiary company is an Indian company, then again capital gain will not arise. Capital gain will not arise. And even vice versa, even the reverse will be true. If this subsidiary is transferring their capital assets to 100% holding company, and the receiver, here the holding company is the receiver, the holding company must be an Indian company, then transfer will not take place, will not regard this transaction. Although there is a transaction which is happening, but we will not regard it as a transfer. Okay. Even it holds goods in the case of amalgamation also, demerger also, you understand. And even if the shares, let's say there is an amalgamation which is happening, and if I have the old company is known as amalgamating company, and the new company is known as amalgamated company, right? So let's say if there is a shareholder, there is some shareholders of this amalgamating company, and on amalgamation, this person is getting shares of the new amalgamated company. So here again, we understand there is an exchange of shares. Earlier, we were having the shares of old company. Now we are getting a shares of new company. So exchange is covered under transfer, but this transaction is also covered by section 47. It says that if there is a shareholder and on amalgamation, the shareholder is getting shares of new amalgamated company, then we will not regard it as a transfer, right? We will not regard this as a transfer. And now, whenever this shareholder will be selling the shares of the new company, then we will include the holding period of the earlier company also, and we will take the cost also of the earlier company, right? And even the same provision will apply on demerger also, right? And conversion of debentures or bonds into, if we were having some convertible debentures or convertible bonds, and these convertible bonds are getting converted into equity shares, then in that case also capital gain will not arise. Whenever these shares will be sold, then capital gain will arise, and you understand you have to take the holding period and the cost also of the previous debentures also. This is not very important, this is applicable for non-resident. If transfer of rupee denominated bond outside India by a non-resident to another non-resident. So government of India issues some rupee denominated bond outside India. So this is actually for foreign investors that they should invest in India. So we have given an incentive to them. So if there is a non-resident who is sitting outside India and this person is having a rupee denominated bond of Indian government, and they transfer their this RDBs, rupee denominated bonds, to another non-resident, then there will be no transfer. There will be no capital gain. This was important. Sovereign gold bonds issued by RBI, and if they are redeemed, sovereign gold bonds are capital assets, and you understand that sovereign gold bonds we have to apply indexation also. But if these are redeemed and they are getting redeemed in the hands of individual, if the assessee is individual, then it is covered under section 47. If the assessee is other than individual, then they are not exempt, it will be taxable in that case. But if the individual is selling these SGBs, then there will be a capital gain. But if these SGBs are getting redeemed, and it is in the hands of individual, then it is exempt. It will be covered. Exempt means it is covered under section 47. I can say that it is exempt because why? Because under section 47, all these transactions do not attract capital gain tax. There will be no capital gain tax. Okay. And also you understand that if you sell your paintings, these expensive paintings, if you sell these expensive paintings, drawings, sculptures, then capital gain arises, right? Capital gain arises. But if you sell these drawings, archaeological collection, any piece of art, any work of art to the government, if you are selling it to the government or to government museum, national archives, in that case it is exempt. It is covered under section 47. So if you sell this to someone else, then capital gain will arise. But if you sell this to government universities, government museums, national archives, then there will be no capital gain. This was added this time. So if the person assessee is having physical gold, and now there is a possibility that now they can convert their physical gold into EGRs. EGRs is electronic gold receipts. EGRs, electronic gold receipts. So if whenever these conversion is happening, physical gold into EGR and vice versa, EGR into physical gold, then there would be no capital gain. In this case also there would be no capital gain. And you also understand what is reverse mortgage. So in reverse mortgage, in the hands of those old parents, it will not be taxable. Okay, so this was section 47. Next is section 50, and section 50 is similar to section 32. It is very much similar to section 32, that is depreciation. So if the assessee is selling their depreciable assets, that block of assets, that person is selling their part of the block or the entire block, then section 50 will be attracted. And the calculation of section 50 is actually nothing but same as section 32. So if you are selling part of the block, let's say the opening value of the block is, opening WDV of the block is 10 lakh, and it has three machines. The opening WDV is 3 lakh. Additions during the year is nothing. I'm using the format of section 32. Let's say you have sold out of 3 machines, you have sold one machine. You have sold one machine, two are still here. Block is still existing. And the money received on sale or disposal, and you are selling one machine M1. Let's say you are selling it for rupees 4 lakh. So in this case, there will be no capital gain. Why? Because 10 lakh plus 0 minus 4. Additions was nothing. Let's say 4 lakh is the money received on sale. So 6 lakh is the WDV. So tell me there is an amount which is remaining, that is 6 lakh. And also we have the block also. Physically, there are two machines also. And so 6 lakh would be the written down value at the end for charging depreciation. Please charge depreciation on the 6 lakh. There would be no capital gain, right? But in case if this part of the block, let's say this machine is selling it for rupees 14 lakh, even if it is more than the opening value plus additions during the year, if we are selling it for more amount, in that case capital gain will arise. So I understand that out of 3 machines, only one machine is getting sold, two are still here. Block although physically exists, but in value it will not, right? You cannot claim depreciation. Why? Because the entire amount is being recovered now. So in fact, you have recovered more. 4 lakh would be the short-term capital gain under section 50. And you understand on depreciable asset, there is always a short-term capital gain, right? Sorry, it will always be short-term capital gain or capital loss also. Let's say the opening WDV of the machine is, of the block is 10 lakh. There were 3 machines. And let's say there was no additions during the year and you have sold all the 3 machines. You have sold the entire block. Let's say you have sold the entire block for 15 lakh. Then there would be a 5 lakh rupees short-term capital gain under section 50. But let's say if you have sold this block for rupees 4 lakh, let's say entire block is sold for 4 lakh. Can you claim depreciation? The answer is no. Why? Because the entire block is getting sold. So here 10 minus 4, 6 lakh would be the short-term capital loss. It will lead to short-term capital loss. And under section 50, it will always be short-term. Why it is short-term? Because what you are deducting is not from a original cost, you are deducting from the WDV, and which is nothing but it was opening WDV, right? It was just of the beginning of the year. That is the reason it is always short-term. So you understand how you will be calculating section 50 capital gain on depreciable asset. Next section is section 50A. Let us discuss 50A, then we'll come to 50B. Section 50A is whenever you sell those assets on which you claim individual deduction or individual depreciation. That is, we can say, on which any asset on which you charge SLM depreciation, that is for power generating units. If you charge individual depreciation on individual assets, not on block of assets, that is on SLM basis. Or you claim individual deduction on an individual asset. Let's say you claim deduction of section 35, that is scientific research, on individual asset. These are assets which does not form part of your block, So if you sold these individual assets, right? So in that case, the capital gain will be taxable under section 50A. It will be taxable under section 50A. So let's say if it is a power generating unit, and they have purchased an asset for rupees 10 lakh, original cost was 10 lakh. And let's say every year they charge 1 lakh depreciation. So let's say it's been 6 years. 6 lakh depreciation is charged. How much is the WDV? 4 lakh. Why? 10 lakh was the original cost. 1 lakh each year we were charging depreciation. So now the written down value is 4 lakh. So if we sell this asset, so what will happen? So first of all, you understand how much is the selling price. Let's say the selling price is somewhere between 4 to 10 lakh. If it is more than 4 lakh, it is 4 to 10 lakh, then it will give rise to profit, but this profit is chargeable under PGBP. It will not be capital gain, it will be PGBP. Up till this original value, it would be PGBP income. But if you sell this asset of more than the original cost, then up to this value, it would be PGBP, and more than the original cost would be the capital gain. So let's say this original cost was 10 lakh, and now you are selling, the written down value was 4, and you are selling it for rupees 13 lakh, 1-3. You are selling it for 13 lakh. Then up to this amount, that is 6 lakh, would be PGBP income, deemed PGBP under section 41. And over and above your original cost would be the capital gain. So 13 lakh, you are selling it for 13 lakh, full value of consideration would be 13, 10 lakh would be the cost of acquisition. So 3 lakh would be your capital gain, right? So what we have to do is 13 minus 10, if it is short term, 13 minus 10, but if it is long term, 13 minus, you have to index this amount also, right? So here in section 50, it will always be short term. There is no scope for indexation, but here indexation can be there if the holding period of this asset is more than 3 years, right? And if you sell this asset for less than this value, so you understand it would be the case of PGBP loss. You can claim it as a terminal depreciation under section 32. So let's say if it is a scientific research asset, if it's a scientific research asset, you have purchased it for 12 lakh. So if you have purchased it for 12 lakh and in scientific research, you claim 100% deduction. So if you have claimed 100% deduction, so you must have claimed 100% of 12 lakh, that is 12 lakh. So the WDV is 0. So if you sell any of for any amount which is between 0 to 12 lakh, it would be PGBP. And if it is more than 12 lakh, so up to 12 lakh is it PGBP. Over and above 12 lakh would be the capital gain. Let's say you are selling it for 15. So 15 minus 12 would be the capital gain. And if the holding period is more than 3 years, then 15 minus, you have to do the indexation of this 12. Right. So this is section 50A. I believe that you are able to recall this provision. Getting it? Okay. Section 50B. Section 50B is related to slump sale. What is slump sale? When you sell the entire unit for a single consideration. There are certain assets, there are certain liabilities, and you are selling the entire unit, entire undertaking you sell. That is called a slump sale. So what would be the full value of consideration? Please remember what would be the full value of consideration. So first you have to compare what is the selling amount, what is the actual consideration which you are receiving, and second you have to also calculate the FMV. So here the FMV would be given to you. If FMV is not given to you, you have to take only the selling price, right? Take actual selling price as the full value of consideration. But if FMV, fair market value on the date of transfer, is also given to you, then you have to compare fair market value and the selling price, whichever is higher, that would be the full value of consideration, right? Less expenses on transfer, okay? Less COA and COI. Less you have to deduct COA and COI. In this case, instead of COA and COI, you have to take net worth. So from full value of consideration minus expenses on transfer minus net worth. You don't have to take COA and COI. You have to take net worth. And how net worth will be computed? Simple. Net worth is how you will be calculating this net worth. Total assets minus outside liabilities. So whatever is your total assets of that undertaking, if there is any fictitious assets like profit and loss account, debit balance, or any fictitious assets, please ignore that. Don't take as a part of your total assets. So how you will be calculating your net worth? Total assets minus outside liabilities. Outside liability could be your creditors, it could be bank loan, it could be debentures. Please do not subtract any share capital, do not subtract any reserves, right? Because these are internal liabilities. So you have to take full value of consideration. What is full value of consideration? Actual consideration or fair market value, whichever is higher, minus expenses on transfer minus net worth. Net worth is total assets minus outside liabilities, right? Of that undertaking which is getting transferred. Okay. While computing your net worth, if any asset is revalued by the assessee, if the assessee has revalued any asset, so you have to nullify that revalued amount. You don't have to consider that revalued amount. So before revaluation, what was the amount? You have to take that amount, right? And whether this, so do you have to index that net worth also? No. In this case, in section 50B also, indexation is not allowed, even if it is a long term. When this it will be a long term, if that undertaking which is getting sold, if it is of more than 3 years period, then it will be a long term, but there would be no indexation allowed under section 50B. Okay. A very important section, section 50C. 50C comes into picture if the assessee is selling their land or building or both. So it is only in the case of real estate transaction, that is immovable property. If the assessee is selling their immovable property, then section 50C will come into picture. So let's say assessee is saying that I am selling it for any X price, selling price. He's saying that I have sold it for X, this selling price, whatever is the price. We have to compare it with the stamp duty value. We have to compare it with the stamp duty value. And we can give a grace up to 10%. Up to 10% variation is allowed, not more than 10%. So what you have to do is just add 10% on the selling price, or in other words, I can say 110% of the selling price. You can add 10% on it, or you can simply say, let's say if it is for 10 lakh, simply do 110% of 10 lakh, you will get 11 lakh rupees. If SDV is more than, after adding 10% also, that is 110% of the selling price also, even then SDV is more, even then if SDV is more, then you have to take the full value of consideration as SDV. You have to take the SDV as the full value of consideration. Then please don't take his selling price, because there is a variation of even more than 10%. In that case, you have to take full value of consideration as SDV, right? See, if the variation is not more than 10%, see, after adding that 10% or 110% of selling price, the SDV is not more than that amount or up to that exact that amount also, then you can take the actual selling price as the full value of consideration. But if the SDV is more, even by 110% of the selling price, then you have to take the SDV as the full value of consideration, minus expense on transfer, minus cost of acquisition, cost of improvement, as the case may be. And if it is long term, you have to do the indexation also. Second important point is, in case assessee says that no sir, this SDV is not correct, and he would like to challenge this SDV, so in that case, this person can, assessee can request the assessing officer, sir, please hire an expert, hire a valuer. These, they don't have to hire it from somewhere. This valuation officer is also part of the income tax department. He's the employee of the income tax department. So in that case, we can refer this, the assessing officer, the AO can refer this case to the valuation officer. When, if assessee requests that, sir, my this SDV is not correct, so valuation officer will be appointed, and this valuation officer comes up with a value which is more than SDV. Assessee will say, no, sorry, sir, we don't want a valuation officer now, please take that SDV only. So if this valuation officer comes with a value which is more than SDV, please, then we don't have to take the valuation officer value. But if in case the valuation officer comes with a value which is less than SDV, then we can take the valuation officer value, provided it should not be less than the actual selling price, right? It should not be less than the actual selling price, but yes, it is less than SDV, right? So in that case, we can take the value or full value of consideration as per the valuation officer. Next important point is that here we are taking the SDV of the date of transfer, right? We are taking the SDV of the date of transfer, that is the registration date. Can we take the SDV of any prior date also? The answer is yes. If there is a prior date agreement, if the assessee can prove that there is a prior date agreement, and how that assessee will prove, he will show that, sir, on that there was a prior date agreement, and on that date, sir, I have received some consideration from the buyer. I have received some consideration from the buyer, but this consideration should be received, must be received through a banking mode. It should be by account pay check, account pay demand draft. It could be banking transfer. It should be by a banking channel. If it is by cash, no, then we don't have to take it. But if this amount is received through any banking channel like account pay check, account pay bank draft, or any other electronic mode, then in that case, we can take the SDV of the agreement date also, right? This I have discussed. Valuation officer I have discussed. Section 50 CA, a very small section. It is only in case of unlisted shares. So if the assessee is transferring their unlisted shares, whatever is the value, we have to compare it with the fair market value. And if the fair market value is more, then we have to take the full value of consideration as fair market value. Section 50D, again, a very small section. If the full value of consideration is not ascertainable, then we have to take the fair market value on the date of transfer. Section 51 is advance money forfeited. So if there were some, let's say, assessee was trying to sell their capital asset, and if this assessee was into negotiations with some buyer, and this buyer has given them the token money, that is called advance money or earnest money, we can call it. In case after some time this buyer comes to us and he says, no, I don't want to purchase this property, so what, please give me my earnest money back. So what we will say, no, we're not going to give you this token money back. This is now forfeited. So whenever this amount advance money is forfeited, it becomes income. How we will treat it? See, if this advance money is forfeited on or after 1st April 2014, on or after, that is the current situation, is that if the advance money is forfeited today, that is even on or after 1st April 2014, so in the year whenever it is forfeited, it will become IFOS income. Whenever it will be forfeited, it will become IFOS income. But scenario was not same up till 31st March 2014. Up till, if the advance money is received, is forfeited before 1/4/2014, that is up till 31st March 2014. So in the year in which was forfeited, we don't have to do anything in that case. It will not become IFOS income. So we have to wait. Whenever the assessee will sell this asset, whenever the person who has forfeited the amount, I'm repeating my words. Whenever the person who has actually forfeited the amount, he will sell it to some other person. So whenever he will be selling it to some other person, in that case, while computing the capital gain, we will reduce the forfeited amount from the cost. We will reduce the forfeited amount from the cost. And if there is indexation, it will be done after reducing the amount, right? But if someone else is selling that asset, the assessee who has forfeited, that person is not selling the asset. Let's say this person has subsequently transferred their asset to their daughter, and now their daughter is selling the asset, then you cannot reduce it from the cost, right? So if the advance, you have to determine when the advance money was forfeited. Is it before 1st April 2014 or it is after 1/4/2014? So if it is after, on or after 1/4/2014, it will be taxable. There would be no problem. It will be taxable in the same year in which it is forfeited as IFRS income. But if it is before, then you don't have to tax it in that year in which it was forfeited. You have to wait till the assessee is selling this asset to some other person. Okay. 51 is done. There is no section 52, 53. These are all deleted section. Then we have 54 series of exemption that I'll be discussing it with you within a couple of minutes. Let's understand some other points also. Capital gain in case of self-generated asset. If it is a self-generated asset, generally these are the kinds of assets which are intangible assets. So if it is goodwill of a business or even of a profession, if it is self-generated, and even there is a small amendment also, now it is not only goodwill, it is now any other intangible asset also. So if it is self-generated, the cost of acquisition will always be nil. If it is purchased, then we can take the actual purchase price. But if it is self-generated, the cost of acquisition will always be nil. So goodwill of a business or profession, right to manufacture, we have a right to manufacture or produce any article or thing, right to carry on business or any other intangible asset. If the cost of acquisition, if it is purchased, then we can take the purchase price. But if it is self-generated goodwill, self-generated any other intangible asset, then we have to take the cost of acquisition as nil. Cost of improvement will always be nil for self-generated assets. But yes, for tenancy rights, trademark, route permits, LUMARs, self-generated, nil. Purchase price, if it is purchased, then we can take the purchase price. But here we can take the improvement, actual improvement cost also. If there is an improvement cost also, for these we can take the improvement, but for these we cannot take any improvement, right? And even if they were self-generated before 1/4/2001, can we take the fair market value as on 1/4/2001? The answer is no. That provision is not applicable over. Why it is not applicable over here? Because it is very difficult to judge the fair market value of these types of assets, goodwill, and because these are self-generated, right? So even 1/4/2001 facility is not available over here. Okay, there is a section 55 fair reference to valuation officer. When you refer the case to the valuation officer, so if whenever the assessee comes up with their computation, and they have used fair market value in their computation, either they are selling it, if they have, see, how do we compute capital gain? Selling price minus cost price, full value of consideration minus cost of acquisition, cost of improvement, expense on transfer. So if the assessee comes up with the computation and this person has taken fair market value in such computation, it has taken the help of the assessee is either in fair full value of consideration, he is considering for fair market value, or in cost of acquisition is he's considering fair market value. Let's say there's any land which was purchased before 1/4/2001, and the assessee is taking fair market value as on 1/4/2001. Assessee is taking fair market value as on 1/4/2001, right? And the assessee is coming up with a registered valuer certificate also, and these registered valuers are private valuers. So AO is of the opinion, no, this fair market value is not correct, because he might have given some money to that registered private valuer, and that valuer has enhanced that value also. They can do so, right? So if the assessing officer has doubt on that fair market value, he can refer the case to the valuation officer. So if value claimed by the assessee is as per the registered valuer and we have a doubt regarding that value, then we can refer the case to the valuation officer. Or second case, it could be if it is the nature of the asset. Let's say the assessee has sold any archaeological collection. So the nature of the that asset is such that AO thinks that it is good if we can refer this case to the valuation officer. So if the nature of the asset is such that it requires valuation, then we can refer this case to the valuation officer also. Second point, they have given some monetary limit also. If AO is of the opinion that the market, the fair full value of consideration which assessee you are telling us, it is not correct. So if it is deviating by how much, either by 25,000 or by 15% of the claimed value, whichever is lower. So 15% of the claimed value or 25,000, whichever is lower. If it is deviating by that value also and the AO is having doubt on that, then he can refer this case to the valuation officer. Okay. Capital gain in case of shares and securities. See, first of all, understand about bonus shares. Bonus shares are the shares which you received free of cost. So the cost of acquisition is nil, right? But if these bonus shares were allotted before 1/4/2001, then you can take the fair market value as on 1/4/2001. We understand that you have received it at a nil value. But if it is acquired before, if they were allotted before 1/4/2001, then there is a facility you can take the fair market value as on 1/4/2001. Right shares? If you are selling your right shares, then right shares are not free. You have paid something for the right share, although it is at a concessional amount, but you have paid something. So whenever you will sell your right shares, it would be the cost of acquisition. Whatever is the concessional amount, that would be the cost of acquisition. But in case if you have received a letter from the company that they are giving you an offer to purchase the right shares, either you can accept that letter. If you accept the letter, you purchase the shares, then there is no problem. Whatever is the purchase price, that becomes your cost of acquisition. But if you don't accept it, and if you renounce this letter in the favor of someone else, if you renounce that letter in the favor of someone else and you take some money from that person you are taking some money, it will again give rise to capital gain, and it would be always be a short term, because this letter validity is generally 30 days. It is for a very short term period. This letter is given to you that if you would like to take the shares at a concessional value, you can take it, or even if you would like to transfer it to someone, you can transfer it. And if you are transferring it to someone and that person is paying you the amount for transferring that right, so capital gain will arise. Because why? What you are transferring your right of purchasing, right? So this is the right which is getting transferred, so capital gain will arise. So whatever is the consideration value for any amount which you are getting, which you are selling it to the other person, it will become your full value of consideration. Cost of that letter is zero, so cost of acquisition will be zero, and it will be a short-term capital gain. Okay. And in case that other person has paid to you because you have transferred the right to him, and that person also has to pay to the company to receive those shares, right? Because he has to pay to the company that concessional amount. So what should be the cost for that person? The cost of shares of that person, because he has paid to two people, right? First, they have paid to you, and second, they have paid to the company. So just add both these costs, it will become the cost for that particular person. So this is how right shares are treated. Okay. Very important 112A. There are 2 or 3 points you should remember about 112A. First of all, 112A is applicable only on equity shares, equity oriented units, and units of business trust. But units of business trust is not in your course. So for you, it is equity shares and equity oriented units. Second thing is that the rate of tax is 10% over and above 1 lakh. So let's say if you are having 112A income of rupees 10 lakh, so you have to apply 10% rate, deduct 1 lakh on it. On the remaining amount, 9 lakh, apply 10% rate. So it is a special rate, 10% would be charged, right? 112A, there would be no indexation. Even if these shares are long term, because 112A is a long term affair. So if it is long term, then indexation is not allowed. Right? This 112A came into picture somewhere in 2018. It came into picture in 2018. So if the shares were purchased on or after 1/4/2018, then there is no problem. So if the assessee has purchased the share, let's say on 1/12/2018 for rupees, whatever the amount is, for rupees 900 per share, then you can take the cost as 900 per share. There is no problem. So if the shares are purchased after coming this section into picture, then there is no problem. You can take the actual cost. But if the shares were purchased before this date, then initially, because you understand there was an exemption over here, but I'm not talking about that exemption right now. You just understand this point. This point says that if these shares were purchased on or before 31st January 2018, then you have to take the actual cost or fair market value. Actual cost or fair market value as on 1/4/2001, whichever is higher. Now, assessee has a benefit that he can take the actual cost of these shares if they were purchased on 31st, before 31st March 2000, on or before 31st, so I'm saying March, it is January. On or before 31st January 2018, please take the actual cost of fair market value as on 31st January 2018, whichever is higher. But please, while taking this fair market value should not be more than your actual selling price. This fair market value should not be more than your actual selling price. So this is important. Equity shares, equity units on which STT is paid, on which STT should be paid, securities transaction tax. That is, the transaction must be happening in recognized stock exchange. But yes, there is an exception. If this transaction is happening on IFSC, International Financial Service Center, which is located in Gujarat, in that case, STT is, even if it is not paid, then it is allowed, because in IFSC, STT is actually there is no STT because this is for non-resident. This is not that important for you, but please remember that on this 1128 10% rate is applicable. But please, while computing the tax, please deduct 1 lakh rupees. Okay. Chapter 6A deduction is not available from 112A. Rebate is not available from 112A. Rebate is also not available from 112A. Okay. And yes, if there is any unexhausted, you remember that for resident individual and resident HUF, if there is, we calculate tax. First, we have to see the special rates, then we have to see the remaining income. And if this remaining income is less than the basic exemption limit, then we can move from 112A also. Movement can be done from 112A, but only for resident individual or resident HUF. 111A is almost similar to 112A, but here the rate of tax is 15%, and there is no 1 lakh exemption is over here. So on entire 111A, you have to pay tax of 15%. Again, 3 things: equity shares, equity oriented units of mutual funds, units of business trust is not in your course. Transaction must be on RSC, STT is paid. If IFSC is there, then there is no requirement of STT. Chapter 6A deduction is not available. You understand that Chapter 6A deduction is not available from special income, so it will not be available from 111A also. But rebate from 111A is allowed. Rebate is allowed. 87A, that is for individual assessee, for individual resident assessee. So rebate is allowed from this particular income, but rebate is not allowed from here. Right. And now there are, the last portion in capital gain is section 54 series, the exemptions. Okay, let me read it out for you. Section 54. First of all, section 54 is the exemption which is available only for individual or HUF. Only individual and HUF can claim this exemption if they have sold, if they have transferred their residential house. If they have transferred their residential house, and if they have purchased or constructed a new residential house, they can claim this exemption, right? For what is the time period allowed? They can, if they would like to purchase a new residential house, it can be purchased before 1 year or after 2 years also from the date of transfer. Or if they are getting it constructed, then it should be constructed within 3 years from the date of transfer. How much is the exemption which is allowed? Whatever is the capital gain or the amount invested. And the most important thing is the amendment which is come into picture this year is 10 crore rupees. Here you cannot get more than 10 crore rupees exemption. So whatever is the gross capital gain or amount invested in new asset, or 10 crore rupees, whichever is lower. Please remember, because right, this time examiner can ask you either question on section 54 or 54F, because this 10 crore limit is amended this year itself in both the section 54 also and 54F also. And whether capital gain scheme is applicable, the answer is yes, because we have given so much time to construct the asset, to purchase the asset. So because we have to claim this deduction, we have to claim this exemption before filing the ROI. So at the time of filing the ROI, if we have not purchased the asset or we have not constructed the new residential house, we can invest in CG scheme also. CG scheme is also applicable over here. 54B is for agricultural land. So if the assessee has transferred, it is again for individual and HUF only. So if the assessee has transferred their rural agricultural land, so see, on rural agricultural land, there is no issue. There would be no capital gain. But if the assessee has transferred their urban agricultural land and they would like to claim exemption, then they can claim under section 54B. Few important points. It is only for individual and HUF. Second important point is that the agricultural land must be used by the SSC or their individual or by the HUF at least for last 2 years. It should be at least for last 2 years. It must be used for agriculture purpose. How much and what you can purchase, what you have to purchase. You have sold agricultural land, you can purchase agricultural land, and that new agricultural land could be urban also, new agricultural land could be rural also. You will get the exemption, and it is easy. How much is the exemption? Amount invested or capital gain, whichever is lower, and within 2 years you will be getting that time. This is 54B. I'm rushing over here because this is something I know that we have already discussed this in detail. So these are the I would like just to discuss some important points regarding these sections. 54 EC is an important section. It is always 54 EC is an examiner favorite section. So it is available to any assessee. See, these 54 and 54B were only for individual or HUF, but 54 EC is for every assessee. Even companies, even partnership firm can claim this. Individual or HUF can, of course, can claim this exemption if they have sold their land or building. If they have sold their land or building or both, and if it is long term, they can claim this exemption. Important point is that here you can, where you have to invest in bonds for minimum 5 years period. For minimum 5 years maturity, you have to invest in NHAI, National Highway Authority of India, RECL, Rural Electric Corporation Limited, or any notified bonds. But it should be for minimum 5 years, right? Capital gain scheme obviously is not applicable because here we are giving you 6 months time only. So within 6 months you have to invest in these bonds. Examiner will confuse you. He will say that within 6 months we have invested this much, and after 6 months we have invested this much. After 6 months, if they have invested from the date of transfer, please don't take that into consideration. So only the amount which is invested within 6 months, only take it into consideration, right? CG scheme is not applicable. And what is the exemption amount? Amount invested or capital gain or maximum 50 lakh. Here, the exemption cannot go above 50 lakh rupees, right? And you have to hold those bonds, or you cannot even take the loan on that bonds before the expiry of 5 years. Otherwise, if you will take, we will make it capital gain. Will arise, we will withdraw the exemption and we will tax it in that very year whenever this this exemption is withdrawn. 54F is an important section. It says it is only for individual and HUF who does not have more than one residential house. Who does not have more than one residential house, it is only for that person. If they have transferred any long-term asset except residential house, they have transferred any asset, they have transferred shares, they have transferred jewelry. Can they transfer land? Yes, they can even transfer land, but not residential house. And what they have to purchase? They have to purchase residential house. They have to purchase residential house. They have transferred any long-term asset other than residential house. Land also they can transfer, but they have to purchase residential house, right? And again, the time limit is same: purchase 1 year before, 2 years after, construct within 3 years. Now the important point is that how much exemption would be available. Here the exemption is formula based. So whatever is the amount invested divided by net consideration. Net consideration is full value of consideration minus expenses on transfer divided by net consideration into gross capital gain. So here the formula, the exemption is formula based. Amount invested. Now the important point is that amount invested, if it is more than 10 crore, please restrict this up to 10 crore. So in numerator, it should not be more than 10 crore rupees, right? So this is an important section, 54F. So 54 and 54F is something which I can expect this in examination for May 2024. There is one more section, G, double G, GA and GB is not in your syllabus. 54D is there. So if the assessee is into manufacturing business, if the assessee has any industrial concern, and if their land or building, their factory land, their industrial land or building is getting compulsory acquired, which they were using for at least last 2 years for their industrial purpose. Industrial means manufacturing purpose. So in that case, if their land or building is compulsory acquired, you understand capital gain will arise. But if they will purchase industrial land or building, if they purchase industrial land or building within 3 years from the date of transfer, they can get capital gain exemption under section 54D. 54D is applicable for all SSC. All SSC, they can claim this exemption, and the amount would be the same, amount invested or capital gain, whichever is lower, right? And again, capital gain scheme is applicable because you have been given 3 years. So this was about capital gain chapter. There were students who were requesting for the quick capital gain revision also. And if you want any other chapter quick revision also, then please let me know. If you require TDS or TCS, either it should be TDS or TCS, or if you require deduction chapter revision, then I'll be posting it to you for you very soon, right? Till then, thank you so much. Bye bye. Take care and study hard. Be very consistent. Now it's April, so you have sufficient days with you. Don't get afraid, don't get worried. You have to give simply consistent efforts. Please make a specific plan. Take your sleep properly. At least you should sleep for 6 to 7 hours at least. Please don't take less than 6 hours of sleep, because otherwise 1 or 2 day, if you will take less than 6 hours of sleep, then on third day or fourth day you'll not be able to study. So at least minimum, please take at least 6 hours of sleep, right? And please be consistent in your studies. You will achieve your results very soon. Till then, thank you so much. Bye and take care.